So in fact, in the United States, again, I don't know what the interest rate is. Okay, but in the United States, when you looked at, if I'm going to remember the trend in interest rates recently, there was a time when interest rates were relatively low. Okay, I'm not going to say how many years ago, and the government made a concerted effort to raise the interest rates, but did it in a gradual, progressive way. And so if you looked at the Federal Reserve rate, you will see a time when every month, which is when they would make their decision, the rates went up by a quarter point. Okay? And then when things, when that provided, the ability for now when there was a desire to ratchet down the amount of activity, okay, then there was room for it to drop. The bigger concern, if I'm correct, like at the federal rate now, is I think something like 1%. And the problem is not how many times can you drop it, but how low can you drop it. Okay? It's hard to see how you can drop, if you drop interest rates below zero, okay, in principle you're paying someone to borrow money. Okay? And so that seems like a hard thing to do. The only place where you can go and drop it off to lower it ultimately is, zero is sort of a pretty hard limit. And so the bigger problem is that you don't have much more of this leverage you can pull when your interest rates are already very low. That's one issue. The other issue seems to be that a certain amount, we saw that there was an argument that interest rates and inflation are somehow close together, okay? Because if I have a choice of buying an object and holding on to the object, or waiting to buy it, okay? If the cost of the object changes relative to what the price of it is, I may be better off putting off buying the object till I actually need it, or buying it so I could sell it later. There's sort of there are arguments that basically say inflation is very closely related to interest rates. And the problem seems to be that economies, it's bad if interest rates, if inflation goes too low. This seems to be kind of a funny thing. That if inflation is too low, like 0%, then there's very little opportunity to make things and to profit from things. And if you get into a situation where there is deflation, where prices actually go down, this seems to be a big problem in economies. You know that Japan went through a period of time when it looked like Japan was going to take over the world. And then things went bad in Japan, and among the things that went bad was that there was a deflationary period. There was this big real estate boom, and all the companies' prices kept dropping, and the real estate kept dropping. And people felt poor, and they couldn't buy things, so prices of clothing had to drop, and everything kept dropping. And this kind of a deflationary spiral is apparently a hard thing to check. So this is one thing that let's say is a big concern now. Okay? Is to try to prevent there from being deflation. Okay? So in short, your answer, the number of cuts is not a problem. The point is that you've got a limited room by which you can cut it down to. Any questions? What is the interest rate in China?
Around 2%.
2%. So they've got a little bit more to play with. Okay? Any questions? There's all kinds of other interest. If the interest rates are low enough, the question of why do you put money in the bank, okay, starts to become a question. And then do banks have money to loan becomes a concern. Okay? So you don't want, in an ideal world, you don't really want interest rates to be too low. Okay?
So I have a very general
Yes.
question. When interest rate goes down, how will the stock market perform?
Well, okay, let's think how it should perform. Okay, we've talked a little bit about this at one point. So one argument would be, there are a couple different arguments here. One argument would be that I could always own a stocks or put my money in the bank. The less desirable it is to put my money in the bank, the more likely it is to put it in stocks, and that would cause stocks to go up. On the other hand, so when they say interest rates go up, stock market usually drops. Okay? Now, we're not living in the usual times now. Okay? And if the interest rates are being cut because everyone thinks the world is collapsing, that's not good for stocks either. Okay? So at some point, the questions of why these things are happening.
Yes. So you're saying that people are losing confidence in the stock market when the interest rate goes down.
Well, I think that what happens is when we live in extremely difficult times, people lose confidence in the world. Okay? And that some of the traditional, let's say, relationships might break down in the limit. Things break down in the limit. Okay? So in general, lowering interest rates, the stock market goes up. Okay? There is some point at which you can't lower it anymore. And if you do lower it, then the stock market will panic and bad things would happen. Okay? So I guess that's my analysis. Any questions? Okay. Any questions, first of all, about the assignment? Let's talk about this for a second. So I said the assignment was due on Tuesday. How many people have started playing with the assignment? Okay, have written their first things and have run them? Good. Okay, any reactions about, any questions or comments about any of the strategies, how the simulator works? There is a new simulator, is this correct? Okay, there is a new simulator which is available from the web page that has a couple of properties that might make it easier. One is the output report is supposedly easier to read. Okay, the other thing I guess is that it permits you to put trades in opposite, not necessarily in order of increasing time. Is that true? So okay, so one thing that's an important thing is that the simulator is assuming that the trades are going in the order of time. Okay, so if you generate your trades in backwards order somehow, trade all the Google trades over time, and then all somebody else's trades over time, they won't be in order, and that messes up the simulator. So sort your trades by time is what I'm hearing you say. Okay, and that may cause some of the artifacts that people were having, maybe because of that. Any other questions about the assignment?
Can we don't use the four data set? I have combined the four data set together, and my strategy won't use the study sets and the test sets.
Okay, first of all, you can do whatever you want because it's your assignment and you're writing a report. Okay, what I would say is the danger of doing sort of in sample testing, okay, where somehow you're going to be running your strategy and debugging your strategy, okay, on your actual data, of course, is that a bug is one that gives bad results. Anything that gives good results is assumed to be right. Okay, so a lot of people were telling me about how they were reporting, massive returns. One problem with certain strategies, one reason is maybe because they had a bug and stopped when they had good results, but people don't stop when they have bad results. So if you want to do it on one file, go ahead and do it, but be aware of what the dangers are. That's all I say there. Any questions? Any other questions about the assignment? Okay, any of the trading strategies or anything else involved? Okay, what I'd like to do today is to talk about one of the other the other trading strategy I mentioned, and you are free to go if you want. Okay, so any other questions for Yu Yi before he disappears until you have your assignment due on Tuesday? Okay. Okay, thanks. Bye bye. Okay, so today I'd like to talk about one of the trading strategies I mentioned on the assignment that is a very important and interesting trading strategy called pairs trading. And it's sort of when we look at some of the trading strategies we've talked about in here, there are some that are popular but maybe ill-defined, and it's hard to understand why they work or don't work, and that might be I put technical analysis in there. There were some that we talked about when we were talking about competitive analysis that are clearly mathematically well-defined and provably good under a certain model, but there's no question, there's no obvious evidence that that model is a relevant model for the stock market or of how what prices do or what hedge funds do or anything like that. Pairs trading is an interesting one in that it is a very important technique that hedge funds do use. Okay, and there is a clear algorithmic. It's a computing tech. It's a computationally intensive technique that hedge funds do use. That there is good reason to believe. It is an interesting idea. And it's representative of what we would call statistical arbitrage techniques. So if you talk about different kinds of strategies that, if you run into a hedge fund type over dinner, and you ask them what do they do, how does their hedge fund work, they might say, oh, we do stat arb or statistical arbitrage or and what does that mean? We've talked about arbitrage strategies as being ones where you lock in a profit because there's fundamentally something mispriced, and you guarantee yourself a profit. A statistical arbitrage, I guess the way I would look at it is, you guarantee yourself a high probability of a profit on a trade, okay? And so if you run enough of these trades, in principle, you guarantee yourself a profit. That's somehow where the word is going to come in. And the idea of pairs trading was sort of pioneered in the 1980s. And it was found by this group at Morgan Stanley that certain pairs of securities were very highly correlated in their day-to-day price movements. Security A went up today, security B went up. Security A goes down tomorrow, security B will go down tomorrow. And if they noticed that if you have two securities that that if you look at their prices, this is security A, okay, and this is security. What's my other color? Here was another one, okay. Okay. If you saw that historically they were very highly correlated, but at some point the differences, the prices seem to drift apart. The argument would be that many of that they will revert. The belief would be that if they have been long historically correlated, these things should revert to their historical pattern of what the mean of tracking each other. So if you have a world where two series are highly correlated, but at some point they start to drift apart, you could make a bet that says one is going to go up or one is going to go down. But if you would short this and bet that this price is going to go down, at the same time you buy this stock, okay, what you're placing a bet on is that the prices will converge again towards their historical average, okay? That is sort of what the idea in the pairs trading is. If you have two stocks whose prices movements are highly correlated, if they start to drift apart, okay, then the idea would be that if you short the one that is has, let's say, outperformed its usual average, and buy the one that has underperformed its usual average, the claim is that what you've got is a bet that these two stocks will have their prices converge. Okay?
What would be the difference between just shorting tab one and not buying?
Okay.
Why does that?
So one question would be, okay, so and this is actually, when we look at my planners will talk about, let's say, how this works. At the end, I'll talk about a case study that was done, okay, an academic study of this kind of a thing. And so the argument would be that the question is, why are they moving? Okay, it might be that they're moving because that this one is that there is some. Okay, so let's think so you're saying, why not bet on one half of the pair?
Well, actually, so the short is basically a leverage bet, right?
Okay,
Is the short a leverage bet?
The short a leverage bet. Okay.
When you're shorting the top one, you're
Yeah.
essentially leveraging it. leveraging on.
Okay, I don't know what leverage is. What you're really betting is that these two prices will converge. That this thing has gone up more than it should, or this one has gone down more than it should. Okay? And that the forces will correct themselves over time. Okay? That's really what you're actually betting. Okay? And the ideas of this kind of a strategy. Okay? So why might this be an idea, for example? Let's say that they diverge. In this example, I showed them diverging because one went up and one went down. They could have diverged because one went up, went down, and the other one didn't. You can see how their fates are diverging here. Why might their fates have diverged? One reason might have been because suddenly a guy who had a lot of this stock decided to buy a boat. Okay? And he just had to sell his shares. When he sold his shares, that momentarily depressed the price of this stock. Okay? If it was an event like that, a temporary event, a temporary supply and demand change, we would expect that eventually the market will saturate with this and it will revert back to its, let's say, reasonable price. Okay? If this thing went up suddenly, it might have gone up because of a supply and demand change. Somebody decided they were going to really wanted to buy a big position in the stock. That caused a temporary upward price movement in this one, but not in this one. The claim would be that these should revert. And when you're buying these pairs, okay, what you're doing is you're betting that the spread will converge. Okay? That is the idea here that you want to do. Okay? Is that...
Yeah, but still, why, if you're betting that it will converge, why don't you just, how does it help you buy the bottom line?
Okay, so a couple of, well, okay, converging could mean that you're betting that this guy's going to come down.
Right.
Okay? So converging does not necessarily, I mean, what does converging mean?
Oh, I see.
It could mean that this guy is leading the world, has started to collapse more quickly than the other one is. These things have moved in sync all along. One could be Ford and one could be General Motors, right? General Motors starts to collapse. The assumption is Ford will start to collapse shortly thereafterwards, right? And so by buying both, what you are doing that's interesting, you're doing a couple of things that are interesting by buying both. One is you are protecting yourself against market movements, okay? Suppose that Obama suddenly announces the world has come to an end. Okay, what is going to happen? Both of these stocks are going to plunge, right? If both of these stocks plunge, what has happened to your portfolio? Every dollar that you lost on this one, okay, in principle, you have made money on, okay, if you shorted this one, okay, that's what you did. You made money on the short, you lost money on the equity. The interesting thing is that if the market goes down, your wealth in some sense is neutral. If the market goes up, both stocks go up. Obama says, I didn't mean it. Now the market's good. One of these things is going to go up. Both of them are going to go up. You bet on one of them to go down, and you bet the other one to go up. It is an offsetting bet. Okay? So the market going up or market going down, you are insensitive to with this kind of a strategy. If you bet one side of this strategy, you are exposed to market movements.
What's the use of that? Because if they're offsetting,
Well, the problem is, here's what, now let's think about it. If you have two stocks that have always been historically the same, they start to drift apart. You bet that this goes down and this goes up. What you're betting on is you will win if they converge. Okay? If the prices converge here, what have you done? You have bet that this one was going to go up. Okay, you bet this was going to go down. You made this much money. You lost this much money. The difference is this. This is the profit that you would make, right? you lost. Okay, when you bet on the short, we shorted this. If this is where the prices converge and you sell, you would make this much on the short. You would lose this much on the long position you took. And so the difference is going to be positive. So wherever the prices converge, that's the interesting thing. Okay?
If you're shorting it, you're basically selling at the current day's price, and no matter what the movements after they converge.
Well, let's say that I now have, okay, this thing has now moved up, this thing has now moved down. I am going to short this, meaning I'm going to bet that this is going to go down. Okay? Every dollar it goes down, I make $1. Every dollar it goes up, I lose $1. Right? I am going long. I'm betting long on this one. Every dollar it goes up, I make $1. Every dollar it goes down, I lose $1. Okay? So what happens? If it converges over here, then I made $1. I made this much money from this. And I made this much money from that. Right? I would recover the spread difference. If they converge down here, I will have made this much money and lost this difference. The amount of profit I make is equal to when they. If I sell when they converge, the profit I make is equal to the spread between them when they diverge. That's the interesting thing. Okay? Do people get that idea? This is actually a clever idea. Okay? And so what's interesting about it is, okay, that somehow the divergence represents the potential profit I will make. If I bet that if I put on the pairs trade, so long as they eventually converge, I will make that profit. If they keep diverging, that is when I lose. Okay?
It seems that you'll make a profit as long as the spread between them is smaller in the future than it currently is.
Yeah, so, right, so I'm betting on them coming closer together. Okay? If they diverge, if they continue to diverge, then I lose. Okay? But if they come closer together, then I win. Okay? And that is the idea of the pairs trade. Okay? Any questions about that? Okay? This is an interesting idea. And so the idea would be, somehow, you find pairs of companies that are historically moved together, that there is good reason to believe that they will move together through time. Okay? Coke and Pepsi is affected by somewhat, to a certain extent, how much people prefer one over the other, but more about how much people are drinking soft drinks. Okay? If, Ford and General Motors clearly are moving together. Right now they're moving together down into the toilet. Okay? But the reason is because, why is that? It's because what is bad for one of these companies is bad for the other company. Right? And if suddenly they announce a bailout of these things, they will both go up. Right? If suddenly the economy gets better and people start wanting to buy cars, both will go up. Okay? So these should have correlated movements. And the idea would be that therefore, well, the idea is not just is that if they have correlated movements that there is somehow a correlation that wants to be retained. Okay? That there is a mean to be reverted to. Okay? Then the claim is that this kind of a trade is a good idea. Any questions? So what are the good ideas about this kind of pairs trade? Why is this an interesting thing? The first thing is, like we said, that this pairs trade is what we would call market neutral, because it doesn't matter if the market crashes. One side of our trade is going to be happy when the market crashes. One side of the trade will be unhappy when the market crashes. It doesn't matter if the market booms. One side of our trade will be happy if the market booms. One side of the trade will be unhappy. So these are interesting because you're betting you're not betting on the market movements. Okay, so this is good from a point of view of diversification. We talked about building portfolios. Okay? If you could have an uncorrelated portfolio with something else, it's a valuable thing. So if, let's say, this pays 10%, this strategy, but it's independent of market movements, that's useful compared to something that is dependent upon market movements. Okay? It can be part of a useful part of a portfolio, even if the returns are not unbelievably good, so long as they're independent of other things. Any questions? The idea is that it's a mean reverting strategy. It is assuming that there is something going to drive these things back together. Okay? That these things move in sync, not just because they move in sync, but because somehow there are forces that keep them together. Okay? And that we think that there will be an active reversion to historical trends. Okay? Any questions? The other idea that is interesting is that these strategies can be thought of as self-funding, depending upon what you do, how you charge the cost of shorting shares. One idea would be, if you're telling me that I'm buying there's two shares, and this one I am going to short, and this one I'm going to buy, what am I going to do? I am basically going to borrow a share of stock from this, right? And sell it. What I could conceivably do is then take the cash from this and buy this stock. Right? Here, this one I'm actually going to go long on. I have to borrow the money. I have to actually spend the money to buy the stock. Here, if I can talk you into loaning me the share, okay, I can in principle sell it now and then use the cash to buy this thing. So there are games here that are interesting about to what extent it can be self-funded. Okay? And if I can have a strategy that will pay me a positive return, and I don't even have to put up the capital for it, that's even better. Any questions? So this is why pairs trading is a good idea. Okay? Any questions? Now, why might pair trading be a dangerous idea? The question is the divergence between two historically correlated stocks, is it due to temporary supply and demand problems, or is it due to the fact that there is a news about one of the companies that has affected one company instead of the other, right? If Yahoo and Google may move systematically, right? But if suddenly the news comes out that Microsoft doesn't want to buy Yahoo anymore, okay, and no one wants to buy Yahoo anymore, Yahoo's price is going to drop. Google's may even go up, okay, by that news, right? So if that's what the reason is, and you interpret this as meaning, oh, they're now going to be together, that's a dangerous thing, right? So you have to make sure that the divergence is not because of news, okay? Or you've got to play this game often enough with moderate enough volumes that you can compensate for the occasional time you get that wrong. If the movements due to, let's say, temporary trading imbalances are more frequent than the movements due to news, okay, this would make sense, okay? Any questions? The other issue is that you have to, when you evaluate a strategy like this, you've got to think about the effective transaction costs. Right now we had this world that we had two stocks that moved together historically. They drift slightly apart. The potential amount that we can recover from this trade is the spread between them, right? Because the money we will make is when, in principle, the most money we can make from this trade is when the prices come together, okay? If the spread between the two prices is small, then the potential profit from betting on the convergence is small, and we have to pay transaction costs. We have to pay the cost of buying the share. We have to pay commissions on that. We have to borrow a share for this, which may cost us some money. Okay, we have to sell it. The claim would be that that transaction costs in a trading strategy like this are potentially very high. Any questions about that? The other thing is that there's an area, I'm hoping next week we'll talk a little bit more about transaction costs. Transaction costs are much more than just how much do you pay the broker to buy and sell your share? Okay? You may say, I don't know how many of you speculate on markets or something. You may say, hey, I don't pay anything to trade. I don't know how much you pay on a per share basis to trade with your broker. Sometimes you have a world where your broker will say, oh, I'm not going to charge you any transaction costs. Okay? What does that mean? It means he's not charging you an explicit thing called transaction costs. But there are still costs involved. One cost involved is, if you suddenly are watching your screen, and these two stocks have historically moved exactly together, and they start separating, there is going to be a certain amount of time you're going to say, ooh, they're separating. Okay? I got to go call my broker. I have to go punch in the number, Broker, go and order this thing. There is going to be a certain time lag in between these things, during which these prices might well move back together. Okay? There is a question of when I tell my broker, go and buy it now. If I have a good broker, the broker may buy it right now. If I have a discount broker, perhaps he will use a slower connection. Okay? And I won't get the price as quickly, the order executed as quickly as the other one. So this movement in prices, okay, is a issue. That would be part of transaction costs. Okay? Any questions about that? The other issue is when I just see that the prices have diverged. Remember, there's a question of how much of this can I buy? Because if the prices of this have gone up, if I decide to short it, the price of this will presumably go down a little bit. Because when I make, or let's say if the price of this has gone down and I'm buying it, clearly when I buy it, that's going to exert a pressure for the price to go up. There's supply and demand. The more demand there is, these prices are going to respond to it. And the question of whether I can get the prices I want, that I seem to have a minute ago, and in what volume I can get it. Okay? This is part of the issue with transaction costs. Okay? And that's one of the things that makes it hard to evaluate a strategy like this. Any questions about that? Okay. What other issues make pair trading less of a good idea? It was clearly a good idea when it first came out, because a lot of people made a lot of money on it. But the more groups that start doing it, if every Tom, Dick, and Harry opens up a hedge fund doing pairs trading, then eventually they're going to look for all these pairs, and it will be harder for you to find them. Okay? The spreads won't exist, and they won't exist for as long. And so, in fact, again, these hedge funds do this in a very systematic online way. There are hedge funds with these extremely powerful computers that are constantly looking at the latest prices across all of these things. When has there been a correlation that is breaking down? Okay? Can I buy it now? Okay? If it's a good idea and everybody can do it, the people who will win are the people who can do this best. Okay? And this is where the technology issues of a lot of these program trading strategies come in. The guy with the faster network wins. The guy with the faster computing to sort of identify the imbalances quicker wins. Okay? This is not something, again, you can do at home so readily. Okay? If you're trying to compete with these other guys. Any questions?
Remember, at one point we were talking about having these computers closer to Wall Street because they get their orders in slightly quicker over the network.
Okay, so right. So one question is, are the electrical delays important? Okay? It is clear that if you look at a real hedge fund, let's say the Renaissance Technologies, which is the one I'm most familiar with, these guys are, they have an incredible computing installation there. They hire lots of PhDs in computer science to do basically their infrastructure issues, because it's important that these things be as, part of it is the smarts of the idea, but a lot of it is the execution, okay? Because you have transaction costs, that eat up a lot of this thing. If you can minimize that in some way, that is a big difference, okay? Any questions? So speed is a big issue here, okay? And speed involves technology. Any questions? Okay, so how do we identify interesting pairs? And, the one that seems most obvious to us is correlation analysis. Certainly you could take, we talked about doing correlation analysis, where you could take the price series, the return series of two stocks, and correlate them and find pairs that are highly correlated. You've got to be aware that the correlations are not spurious. Okay? So, this now becomes a little bit of an engineering issue. The longer you look at a stock in time to see that their price movements are correlated, the better. The more accurate is, the less likely the correlation is to be spurious. But on the other hand, it's also less likely to account for drifts in things. That the businesses have changed over the years and things like that. Competing companies in the same sector tend to make natural potential pairs. Why is that? It's because, we talked about the returns on a company. There was sort of some specific risk and there was systematic risk. The systematic risk that two companies in the same sector have, okay, are very much in common. So that would be an argument that two companies competing companies in the same sector presumably should move according to stay in sync because they face similar phenomena. Okay? And so that's a reason why perhaps those make better pairs. There are also certain pairs, certain aspects of pairs that happen because of weird things in the way stocks are traded. Okay, so in some companies, like let's say General Motors, there are several classes of different stock that are traded. General Motors is an old company, and there are different. It's not just that if you looked at General Motors, it's not that there is one set of General Motors stock that is traded. There's often common stock and preferred stock, which may differ based on voting rights or how they get treated in bankruptcies. But for the most part, basically would get the same dividends, okay, from the companies. If so, then these two movements, the common and the preferred stock, should move in unison, okay? And these might be good candidates for pairs. Similarly, there's certain companies that are traded on multiple exchanges. Let's say that you could buy a stock on the New York Stock Exchange, but also on some kind of an electronic stock exchange, archipelago. If the prices here diverge, they clearly should reconverge, okay? Because it's ultimately the same stock. So these might make good pairs to trade on. Or there sometimes are companies that have international subsidiaries, which are basically drawing from the same let's say, profit pool. Like there used to be two companies called Dutch Shell and Royal Shell that were somehow owned the same thing. And so therefore, somehow their movement should have really been the exact same. And so there was a lot of pairs trading in any slight deviation among these companies. Okay? So the important thing to recognize is that there are some pairs that are logically going to really have to stay together. So small price differences should be taken advantage of. Okay? The more divergent the companies are, the bigger spreads we would expect. And of course, the bigger spreads are the ones where there is more potential profit on. Because our profit on this trade is ultimately when these two come together. Okay? Any questions? And finally, if we're looking at pairs trade, the pairs do not have to both be separate companies. You might, let's say, have one of the pairs might be a index portfolio. Let's say that bets on the S&P 500, and the other which might be a company. Okay, we saw that companies, that because of, if you look at the CAPM theory, okay, most companies, a lot of their earnings track very closely what the index is doing. Okay. So if there is divergence between the index and this one company and there is no news for it, that might be an argument that should be a pair. Any questions? Okay. So let's look at some examples, and then I'm going to talk about an academic study of these things that I think is maybe more interesting. But here were some examples I stole from an article about pairs trading for people. Here was an issue that they were talking about. There was there's an index of semiconductor stocks, which I gather you can trade on. Okay? And there is Intel, which of course is the biggest probably component of the semiconductor index. And what this chart would represent is, what is the ratio of the price between a share of Intel and the semiconductor index? And if you look at it over this 4-year period, you'll see that the ratio of Intel to the semiconductor index has actually been very, very consistent. It has been between 0.6 and 0.8, okay, over this 4-year period. Some of those times were good times for the semiconductor industry, and some of them were bad times for the semiconductor industry. But the ratio between these stocks was these indices or stocks were very stable. If now you come up with a world where suddenly, if you look at the end of this time, the index, the ratio is lower than it had been over this 4-year period, that is a suggestion that somehow this relationship is breaking down. Okay? This is the kind of an opportunity that a pairs trader would look at. If they see that for some reason the ratio is now different than it used to be, there is a bigger spread between Intel and the semiconductor index than there usually is. Okay, than there has been, in fact, for 4 years. If there is no good reason for it, again, in this case, if this is supposed to be Intel over the semiconductor index, if it dropped, that means Intel did worse relative to the semiconductor index. If one of Intel's factories caught fire, that would be a good reason for this. But in the absence of news, then this is potentially a trading situation. Okay? So what you're monitoring here is the price ratio between the two securities. Okay? And if you get a world where the price ratio is historically flat long term, okay, and there is now either a dip or a rise in it, if you believe that this ratio will revert to its historical mean, okay, basically what you should do is, if in this case Intel's price has dropped more than it should, this is a time to buy Intel and simultaneously bet that the semiconductor index is going to go down, namely shorting that. Okay? Any questions? And the idea would be that now that you see the spread, you would say, now is the time to do this. You plot a historical line for when they should come together. The time to sell is presumably when they get back together to the historical mean. Okay? If you look at it, it's crossed the historical mean many, many times in this interval. Right? And when it crosses that historical mean, that is when you will profit from this trade. Any questions? And again, the important thing to see here is that with this kind of a trade, you do get market neutrality. Suppose we have two shares, okay, one of which is, stock A is $20 per share, stock B is $10 per share. Okay? If I think that stock A, if stock A has been down and B has been up and historically they've moved together, then what would I do? I would want the same dollar amount on either side of the trade. Not the same number of shares, but the same number of dollars on either side of the trade. So if, this is because the ratio between them, we plotted the ratio was not always 1. The ratio there was, remember, between 0.6 and 0.8. That means that to make a dollar neutral trade, you would need to have more of one stock than the other. So here, if we go long on 100 shares of this at $20 a share, we would be long $2,000. If we short 200 shares, we'll be short $200. Our net long and short is 0. If both stocks go up by 50%, it's still 0. If both stocks go down by 50%, it was still at 0. Okay? Yeah, what we hope is that somehow that the prices will converge back to their normal thing. Any questions? Again, here is another example from one of these slides of what might be an interesting trade, okay, that they proposed. They said they looked at Wells Fargo, which is a famous American bank out west. There's Washington Mutual, which is another bank, okay? And what did they notice? If they plot the correlation between the two companies, there is a high correlation. Both of them are in the financial sector. Historically, the ratio between the stock prices was 1.5. At this point, it was 1.39. You need a notion of when is the difference in the ratio significant relative to significant enough to trade. A common statistic reason seems to be when it's two standard deviations from what it should be. So if we look at this thing, we can look at what is the standard deviation of the ratio. Every day there is a ratio between Wells Fargo and Washington Mutual. We can compute what the standard deviation is. Okay? The historical mean was 1.58. The standard deviation over the year was 0.4. The argument was that this is now two standard deviations under what it should be. That would be what would trigger the bears trade. Okay? Any questions? And this chart shows that, well, you may want to make sure that the companies are really doing the same as they should be. And both of them seem to be having, the argument is that their performance and fundamentals is similar. So that might be an argument that it's not news that is causing the divergence, just some sort of temporary weirdness. Any questions? And so if you looked at this particular trade, they say this is a happy ending because what happened, the ratio went under two standard deviations from where it used to be. It went down a little bit further, but you held on until it reverted back to its historical mean. Okay? Any questions? Now, what made this an interesting example is, I don't know if any of you have heard what has happened to Washington Mutual in recent times. Wells Fargo is seemingly the one bank in the United States that is healthy, and Washington Mutual essentially went bankrupt. Okay? So that was an example of where, if you made the bears trade, a few months ago, okay, that would have been a very dumb thing to do, okay, because their fates did dramatically diverge, okay, and that is the concern that you have with these trades. Any questions? So, when we think about this, the one thing that we need to think about before we get too excited about this idea, in my mind, is you need to think of a mechanism here as to what is causing them to revert to the mean. Okay? So, reverting to the mean is something that requires a driving mechanism. Okay? It is not something that sort of happens just by chance. If I had two random walks, okay, and they were diverging, if I had two random walks, I was flipping coins, and this one happened to wander away, and this one happened to wander further apart. There is no reason to bet, if I'm just flipping coins on each of them, that they're going to come closer. There is no driving force that is going to say, well, if this one got heads, this one's now suddenly going to get tails. If they are independent coin flips. Does everybody see that? So bears trading would be a dumb thing to do if we really believe that prices are done by independent random walks. Okay? You need to have some kind of a phenomenon that is driving it towards it if you think this is going to be a well-founded strategy. And so when you look at, let's say, what is a theory or an argument for it, okay, the one that to me is, let's say, most convincing that I read is some kind of a principle that they call the law of one price, okay? And it would argue that if you have two investments that will have the same payoff in all different states of the world, then they should have the same current value, okay? What does this mean? If I have a stock, let's say that there are, different kinds of events. Let's say there's a meteor could hit the Earth. Okay, there is an earthquake. There is, sort of good, a boom, there is a crash. And if this one's going to go and a meteor goes down by 10%, and this goes down by 10%, and this goes up in the event of an earthquake, it goes down by 30%, and this goes down by 30%. And in a boom, it goes up by 50%. 50%. If in all circumstances the stocks behave, the securities behave the same, there is no reason why the value of one should be different than the other. This seems to me to be a rational theory here, right? If we had two different securities, both of which have the property that in all different market conditions they behave the same, then they should have the same value. Okay? There's no reason why one should be less valuable than the other. That, I think, is a perfectly reasonable statement, proposition. Now, if you think about that, then what is the meaning of a strong historical correlation? A historical correlation means that when the day there was an earthquake last year, both of them went down. The day that there was that there was a boom, both of them went up. If there's a strong correlation over a period of a lot of times, the argument is that they are behaving the same in a large number of different states of nature. And therefore they should basically have the same value. And so if they don't have the same value, same price, they have the same value, and so the prices will converge on them having the same value. Any questions about that? That to me is a moderately satisfying argument. Okay, if you believe that the correlations over a long enough period to capture a large number of states of the market. Okay, any questions? Another explanation that people use for why pair trading might work is the idea that there are temporary risks, okay, that happen that eventually pass, okay, and that prices reflect the concern of a temporary risk, okay. Let's say we use an example of Google. We've talked about, I guess I've used the silly example of, Google would go bankrupt if Sergey Brin took all the money and flew away with it, right? Now, if we believe that, then every time Sergey Brin starts his plane, we should get nervous until he flies back and we see that the money isn't gone, right? Now, we don't expect him to steal with the money, okay? But there is a certain risk of that will pass the moment he comes back from his plane trip, okay? And so the argument would be that there may be changes in risks of bankruptcies and things like that are short-term concerns that last for the length of the plane trip. Will the CEO's plane crash as it flies from here to Washington to beg for money? Okay? If it crashes, the stock price will go down. We're at risk of it crashing so long as the plane is in the air. But once the plane landed, that problem has gone and it will revert back to its normal situation. That would be the argument, another argument here. Okay? Any questions? Okay, so these are possible mechanisms for why there should be something driving a regression to the mean. Any questions? So that said, I'd like to now go through, I found an interesting paper on what I consider to be a good, careful study of the performance of pair trading. Again, a lot of these things have academic, when you Google pair trading, what you will find, of course, are a lot of people trying to sell you software for pair trading, tell you this is the greatest thing since sliced bread and you should buy it to trade your own stocks. When you Google Scholar, you end up getting research papers on, these kind of strategies. Okay? And so that's probably a better way to think about, to look at these things. So here's something in the Review of Financial Studies that I looked at, which was a study of a simple pairs trading model for over a 40-year period. Okay? And what their basic results were, that a simple trading rule yield what they called an annualized return of up to 11%, okay, on the self-trading financing pairs, portfolios of pairs. So they were able to show that there was a significant effect, that this was there was a positive return here to be had that seemed large enough to withstand trading costs. Okay, I mean, sort of execution costs and things like that. What I'd like to do is to now go through a little bit about what kind of experiments they did, what flavor of pair trading strategy they did, how they did the experiments, partially to get an insight into pair trading, but also to get an idea of how you do a careful study of these back testing, of these strategies. Okay, what do you do to validate that a strategy works or does not work? Okay. So what was their strategy? What was their pair testing strategy? What they did was they started in 1962 and they waited 1 year. Okay? Then they spent that 1 year, and after 1 year of data, they would measure pairs stocks because of how similar they were. The similarity over the past year. Then what they would do is, at the start of the month, set aside a 6-month window and identify pairs that had diverged significantly. Okay, at this point in time. Then they would, over the next 6 months, if the prices converged, they would sell. If 6 months later the prices hadn't converged, they would just sell them anyway. Okay, to close the position. You're waiting for these prices to converge. Sometimes they don't converge, right? And so to get out of it 6 months later, one way or another, if they hadn't sold it, closed the position, they would close it after 6 months. And then 1 month later, they would take again, what were the correlated pairs over the last 12 months, and do another strategy executing for the 6 months. And they did this now for the remainder of the 40 years. Okay? Any questions about what their timing of the strategy is? 40 years. It was 1962 to 2002. Okay? I was born in 1961, so I can assure you there's 40 years between those dates. Okay? Any questions? Okay? So what was the idea here? Their rule was, as we said, they would buy a pair the moment its ratio spread was outside 2 standard deviations compared to the last 12 months. How frequent is something outside 2 standard deviations? If we remember what we learned about the normal distribution, if you look at the mean, if things are normally distributed, about 67% of the mass is within 1 sigma of the mean. About 95% of the time, the mass is within 2 sigma of the mean. So that's an argument that says that about 5% of the time, you are going to be 2 standard deviations outside the mean. Okay? So it's frequent, but not unbelievably frequent, okay, when you have a drift that is that big. Any questions? And so here was sort of an illustration from their paper about what they did. They had one historical pair that, at this point, they normalized it, so at this point they were identical, okay? And what did they do? Because this pair they decided, these were both, I think, tire companies at the time, okay? At the beginning, they waited until the pair was, there was a 2 standard deviation gap between the stocks. Then at this point, they shorted this one and bought this one. And they waited, okay, and they waited. If at some point they equaled, at this point they closed the position. And then they waited again until there was 2 standard deviations of divergence between them. And then they waited for it to close. And when it closed, they got out. And they waited. And so in the course of this 6-month period, Okay? They might have gone into this pairs trade many times. If they went into the pairs trade many times, they made a profit every time they went into it and got out of it. Except possibly the last time. Because they said these pair was valid for 6 months. At the end of 6-month interval, they sold these two, regardless of whether or not they had converged. So the important point is that the pairs trades, all of these pairs trades made money. This one may or may not have made money. The one that ended forcibly, because they might have been diverged by then. Any questions? Okay. And again, they sort of said for every pair trade, they put the same dollar amount on it, $1 in each direction, just for the purposes of the simulation. Any questions? Now, what did they do to form pairs in this study? The first thing they did is that they eliminated stocks that were not what they considered to be adequately liquid. What does liquid mean? If you have a stock that is not traded very much, okay? There's very few people who are buying and selling this stock, okay? Then, if you suddenly decide you want to sell it, you will have a hard time finding a buyer for it, right? If you want to find a buyer for it, the best way to do it, you have to drop your price. So if you want to measure, let's say, how much you're doing when you're buying and selling, you would like it in a strategy like this, that whenever you buy or sell, it does not affect the price very much. So you should limit yourself to liquid stocks. Okay? That might suggest large stocks. Their definition of liquid was that there was at least one trade every day during the period. Okay? And that doesn't sound like a very strong case for me, but I think especially back in the olden days, in the 1960s when they started their studies, okay, that stocks might go days, certain small stocks might go days without actually having trades. Okay? They found the matching partner. They did not do correlation analysis. They did it by they took each stock price time series and it normalized it, presumably so that the mass of what's underneath it is the same. Okay? So the average value of the prices are the same. And then what they did was they computed the sum of squares every day. The sum of the squares of the differences between the two prices every day. So they're looking not so much at correlation, but at somehow the absolute movement of the prices. Okay? Any questions about that? Why might this be better than correlation? Let's say we have two stocks, one of which is going, whose prices are going like that, the other of which is growing linearly but slower. The correlation of these two prices is one. Whenever one of them goes up, the other one goes up, right? But still the prices are sort of, the ratio between them, okay, is somehow diverging. Or the prices here are diverging. Instead what they did was they correlated it to somehow this sum of squares distance between things. Okay? Any questions? Okay? And to compensate for dividends, they assumed these dividends were reinvested. So they did a normalized price, and they also reinvested the dividends. Any questions? They then later did different experiments where they used different pairs. So they might be interested in each. Also, what they did is they found a pair for every stock. So for every stock, they found out which was its closest neighbor, and that was going to be the pair, a pair, possible pair. Then they would bet on certain pairs where they restricted the pairs to either the best pairs, the ones with the strongest correlations among all pairs, or they restricted pairs to the strongest correlations where they were in the same industrial sector. Okay, and they get different results for these kinds of things. Okay? Any questions? One issue that turns out to be not trivial to think about here is how do you measure what your return is? Your return is a function of, if we think about normally, it was easy for us to compute a return over time because we had a certain amount of wealth at one point. We looked at how much wealth we had at the end, okay? And the return was somehow the difference between the ratio of this to that, divided over time. Now the problem is in this pairs trading strategy. Certainly you could simulate the pairs trading strategy and figure out how much money you have at the end in absolute dollars. But the bigger question is how much capital did you put down? Okay, what was the numerator here? Okay? Again, I talked to you here about the idea that pairs that open and converge have positive cash flows. Pairs that open and close, that open but don't converge until they're kicked out, okay, may have positive or negative cash flows, depending upon whether they converged or diverged in that period. But the issue in trying to figure out what the return of this investment strategy is, you have to figure out how much capital are you converting into this thing. If you assume a completely self-finance strategy, where someone loans you a stock for free, you sell it and use the money to buy the other stock, okay? Then in fact you've never put in a single cent, and any profit represents an infinite return, right? So you need to think about how much capital is committed, and there's a couple of different ways you might think about it. They sort of modeled it by saying that borrowing a stock didn't cost you money, okay, or shorting it didn't cost you, but you didn't actually get money for shorting it. You sort of would pay the difference at the end, okay? They assumed that it was $1 to go long and nothing up front to go short. If this is true, then the question of how much capital do you need? You need to be able to buy every pair that you want to trade. There's still two different ways to think about how much money you're committing to this strategy. One says that I am going to be looking at 20 pairs, and I'm going to have my dollar waiting for the instant that this pair was something to be traded, and then I would buy it. If so, I'd have to commit $1 for every potential pair I was trading. The other possibility is that at some points there might be lots of pairs that are active trading. On other pairs, they haven't diverged, and I'm sort of just waiting for them to diverge. At this point, I needed no money. At this point, I needed this much money. Accounting for how much capital you have here, whether you're using committed capital, which is how much money you set aside potentially to buy things, or employed position, how much you actually spent on stock at this point, makes a difference in what the returns are. Any questions? Okay? So what are the results here, okay, when they did this kind of a strategy? One thing that they did was they took a look at their pairs, and they did, remember, for every stock they found its best pair. They then did a couple of different portfolios. One is they only bet on the 5 pairs that had the strongest correlation. They bet only on the top 20 pairs that had the strongest correlation. The third category, they bet on pairs that had strong correlations. They were like the 100th to 120th of all possible pairs. But not the strongest ones, because there turn out to be some artifacts among the strongest companies, the ones that have the strongest correlations. And the last one was they bet on all their pairs. And if you look at this strategy, what was interesting about it was, in all cases, there was a positive return on this strategy. So the pairs trading strategy made money over the 40-year period. Okay? depending upon whether you count it on committed capital or employed capital, made a big difference in how big a magnitude, what your return really was. Okay? Because in this one you had to, it depends on how much money you think you're spending on this strategy. Okay? Makes a big impact. The other thing they did was consider what happened if they couldn't sell the stock immediately. Let's say that you're monitoring these prices, and this one's doing this, and this one's, and you say, oh, now sell, now. Okay? The truth is that by the time your broker will get around to selling it, these prices will have diverged. So to try to capture that kind of a slack, they said, what happens if our orders get executed one day after we wanted them to be executed? And that kind of a delay was enough to significantly reduce the profitability of all of these strategies. So performance is sensitive to the execution time. It's sensitive to how you account for how much capital you use. But it's positive to all these things. It's relatively insensitive to which pairs you use. Okay? Any questions? Any questions about what those results mean? There were some other interesting statistics they found out about their trades. One was, what was the actual price difference? We said that we triggered a sale whenever two prices had diverged by two standard deviations. Now, if you have two stocks that are very, very close to each other, if historically they're very highly correlated, the standard deviation of the returns of the difference in their returns is going to be very small. So 2 times a small number is a small number. And your profitability for these things is proportional to the maximum profit you can make is to recover the spread. That if they had diverged by $5, then the most what you would make when they converged was $5. So the profitability depends upon how much of an absolute difference is there between the stocks prices of the up and down pair. And the argument, one concern is that the pairs that were most strongly correlated, their divergence meant a very, very small spread in terms of actual dollars or percentages. Okay? So there was only a 4% spread that was triggering, the execution of these strategies. So each time you do it, there's not much there, a lot that can get lost in transaction costs. Okay? In fact, if you bet on all the pairs that are less strongly correlated, then in fact there is a bigger spread here that is potentially capturable. Okay? And that becomes interesting. Any questions? And again, what they took a look at was how many months were these pairs open. There was a 6-month period, and the average pair was open for about 3 months. Okay? And that there were several times that in any one period you may have bought and sold. Okay? Many of the, several times. So those are the kind of statistics that they had. The other thing that they found out was that almost all of their pairs, although they computed their pairs based on correlation and did not enforce that they were from a particular sector, almost all of their pairs, 80%, 70%, turned out to be between two stocks in the same industrial sector. The reason was because if you have two stocks that are highly correlated, the reason why they are highly correlated is probably because they are facing similar market conditions. And those are more likely to be true in stocks that are both utilities or both financial companies than one that is an industrial and one that is a utility. Any questions? So that's why it's interesting that most of the pairs, were within a sector, not crossing the sector, which is down here. And in particular, the most highly correlated ones were all utilities, which means things like the company that supplies water or that supplies electricity, something like that. And the reason is because these prices seem to move in response very much to certain specific things like the price of gas or something like that. Any questions? The other thing that was interesting from their experiments is that when they randomly selected pairs, not based on the correlation, but just married people at random, I decide to marry you to you, okay? That in fact, again, those prices would diverge occasionally, okay? But if you bet on them, you got negative returns. Somehow the idea that there was an initial correlation was important in order to make the pairs, because you need some reason to believe that there is going to be something driving them back. And so having the correlation was important in these pairs. Any questions? I think basically, and when you looked at where the returns came from, one thing Mordecai asked that was interesting was, would it help to just bet on the one on the bottom? You could either sort of bet on this stock moving up, we're betting on this stock moving up and this stock moving down. In principle, there is some effect that we could gain by just betting on one half of that thing. We expect that it's more likely that this is going to somehow move up than move down. Okay? It turned out that most of the returns came from the short position, okay, as opposed to the long position in these trades. Okay? So it wasn't a completely symmetric thing. But of course, to make it risk neutral, you need to bet on both sides. Any questions? Okay? The final thing I'll say is they plotted over time the monthly returns from this. And I found it actually very interesting. If you look at this strategy, in the old days, from the 60s to the mid-70s, to the mid-80s, you will see that the monthly returns from this strategy were almost all positive. Okay? Meaning that it was consistent in almost all market conditions. This was a good strategy to be done. Then starting in the 80s, more months were negative than before. Can anyone come up with a reason why that might be? Why is it that the strategy seems to be less effective starting in the mid-80s? Okay?
Maybe the news is spread most quickly than this news.
So one possibility you're saying is it might be that these things, the reason why they diverged before was because there was news that took a while to get out. Maybe. I would argue that it probably has something to do with the fact that you started having hedge funds that started trading on this idea in the 80s. And so the more companies that start doing it, okay, they are squeezing out the profits that can be done with this. There is less left in the data for you to somehow take advantage of. Okay? So what's interesting is at some point, okay, it made a big return at some point, then it became a lot more volatile with this kind of a trading scheme. Okay? But again, it's still a very popular hedge fund strategy. The statistics I had said that in 2000, the hedge fund industry was about $137 billion. 80% of that was invested in market neutral strategies, of which this is a representative example of one. Okay, so these clearly are still important strategies, although the game is a lot harder than it used to be. Any questions? Okay, any questions? In fact, the only thing that I can tell you as a final note, these are clearly useful and good strategies. The other thing that I can tell you is that the strategy that the group that invented these things initially made great profits, and then a few years later they disbanded with losses. So, again, it's a good idea. There is still risk in it. It still has to be executed properly. But it's an interesting example of a statistical arbitrage technique. Any questions? Okay. Any questions about the homework? If not, thanks for your attention, and we'll talk about this next week. Beat on the homework is something I look forward to getting your reports. Okay, thank you.